All right, the euro escaping another day of losses against the dollar, but the currency still under pressure as doubts fester over Europe's debt crisis. European Union finance ministers meeting tomorrow in Brussels to try to figure out some resolution to this crisis. Joining me now is Mark Dow, portfolio manager, Pharo Asset Management. Mark is the former economist at the IMF. He's also been at the U.S. Treasury. Are we seeing some kind of domino effect, Mark? I mean, we talked about that, 30 years ago, 40 years ago in Southeast Asia. Do we now apply the same theory to what's happening in Europe?
No, I think really the market was ripe for a pretty serious correction, and that was part of the reason for it. I mean, it's a good reason, right? There's some serious risk coming out of Europe, and there's even a small chance that something spills into, let's say, something systemic.
But why do you say that the market was ripe for a correction? I mean, the market doesn't have any real feelings or real emotion. I mean, why were investors ready to hit the sell button?
Well, you can just see in some of the patterns, right? There were a lot of stocks and stock indices that were going down on heavier volume before this crisis got severe. And really, this looks like it might be the culmination of a topping process that started back in October, and we had another bout of it in January. The market often gives you some warnings before selling off. And that's really what it seems like. The fundamentals haven't changed that much. Europe is a bit of a risky situation, but in the U.S. things are cruising along. We have a slowdown, a little bit of a slowdown off of the peak that we got from the rebound bottom. But really, it hasn't changed as dramatically as the price action would suggest.
So then, what are investors taking away from all this? They take a look at the headlines coming out of Europe and they just say sell, or are they actually looking for bargains right now?
I think the former. We went into a kind of risk shedding mode about a week or so ago, where you get to a point where people say, that's it, I have too much risk on my books, and I'm going to take my risk down until I get to a point where I'm either flat to my benchmark or flat overall if you're a hedge fund. And until you get to that point, you really don't care much what the news is. You don't have that risk appetite anymore. And I think we're in that indiscriminate selling phase. And you never know how long it can last. Probably not too much longer, but you hope you recognize it when you see it.
What about market liquidity now? I mean, if you're talking about people de-risking their balance sheets, getting out, looking at their benchmark comparisons, does this mean that there's just less money in the market, so you're getting a widening of bid and ask spreads?
Well, I think risk aversion typically widens out the bid-ask spread. That's a normal course of affairs, and you're definitely seeing that. Prices are gappier, and the bid-ask is wider. You're seeing that for sure.
All right. So what do investors take away from this? Just sit on the sidelines until we get more clarity out of the European Union?
Well, it may be that, or it may just be until people are finished de-risking, and then they'll find reasons to come back in. Often the news follows the price action rather than the other way around.
We end up looking for a headline in order to justify what actually happened in the market.
When prices go down, we'll find a reason to ascribe to it. It may or may not be valid, and I think we're at that point now where until people feel comfortable about their risk profile, they're not going to step out and take risk.
What about the level of the euro versus the U.S. dollar? Are we going to see parity? We're at like 123 right now with the euro.
Yeah, you never know. I mean, over time, the euro should depreciate significantly, but we saw today, very interestingly, and I think it started a couple of days ago and got interrupted by the German announcements about some regulatory changes.
What do you make of that German announcement? It was unilateral, didn't seem coordinated with any other EU government, this idea of banning naked short selling, this idea that you actually have to borrow the shares of companies that you would then short. Does this seem like a bizarre move on the part of the German politics?
No, it's not at all. It's just political. I mean, if you think about where they're coming from, if you're sitting there in Germany, in the German electorate, you're saying, gosh, this is getting worse. And the worse it gets, the more it's going to weigh on my balance sheet, the more I'm going to have to pay for it. We need to do something. And Germans like order. They like rules. They like things that function.
But I mean, isn't this the price of European unity? I mean, didn't they foresee that at some point or another that their southern brethren would actually need a bailout?
Perhaps or perhaps not. I mean, I'm guessing that they didn't think a bailout would be necessary when they signed the bottom line a long time ago. But nonetheless, Merkel needed to be seen as acting, as doing something, as sympathizing with her people.